Okay, let's get right into it. Welcome to the deep dive. Today we are tearing apart the recent earnings release for Designer Brands Inc. It's DBI.
Right, the parent company of DSW, kids, Vince Camuto.
And this call was, it was the talk of the retail sector this quarter.
Oh, absolutely. Because the results told one story, but the way the market reacted, that told a completely different and, frankly, a much wilder story.
That's the perfect way to put it. This feels like a masterclass in how market positioning can just completely steamroll the fundamentals, at least for a day.
It is. The Q3 numbers hit the wire pre-market, and, within hours, the stock just exploded. It signals that the market was positioned so negatively, so bearish, that any good news was going to be like throwing gasoline on a fire.
So we need to look at what they reported, but also who was caught on the wrong side of that trade.
Exactly.
So let's jump into those core numbers because the contrast here is just fascinating. We've got a revenue miss, which is, not great.
A minor one.
Coupled with a profit beat that was, frankly, seismic.
Yeah, let's start with that top line. So DBI reported $752.4 million in total revenue.
And the consensus was what, around 763?
Just about. $763.4 million, so it was a miss of about 1.4%. If you only saw that headline, you'd just think, okay, another retailer struggling a bit.
Right, business as usual. But then you look at the earnings per share.
And that's where the explosion happened.
Adjusted EPS came in at 38 cents.
38 cents. And you have to remember, Wall Street was collectively expecting 18 cents.
So more than double?
More than double. You're talking 111% beat, a 20-cent positive surprise. That is the kind of thing that forces a major reevaluation.
And it did. The stock finished the day up nearly 50%.
50.
To around $7.20, yeah.
And the volume?
Oh, the volume was just ridiculous. What was it, 11.5 million shares?
Something like that, which is about 14 times the normal average daily volume for this stock.
So when you see a profit beat like that, followed by volume like that, the signal isn't just the business is healthy.
No. The signal is someone was forced to buy. A lot of someone's.
Exactly. But before we get to that technical pressure cooker, we have to understand the fundamentals because they did something right to justify that panic.
I did. The reason they beat EPS so dramatically, even with a revenue miss, it all comes down to operational excellence. It's an absolute masterclass in managing margins.
Okay, so that's the real story here. Not the sales number, but the profit number. How did they pull that off?
It's discipline. Pure and simple. Consolidated gross margin expanded, get this, by 210 basis points year over year.
210.
Up to 45.1%.
Yeah.
Now, for anyone not deep in retail accounting, 210 basis points, what does that even mean?
Right, break that down.
It means for every single dollar of stuff they sold this quarter, they kept 2 extra cents of profit compared to last year.
And that 2 cents, when you multiply it across hundreds of millions in sales?
That's your EPS beat. It flows straight to the bottom line. It's a massive operational swing in just 12 months.
So what were the levers they pulled? What did they actually do to make that happen?
Management was very clear on this. 2 main drivers. First, and this is the big one, was lower promotional intensity.
So fewer sales.
Fewer markdowns. They got very disciplined. They specifically said their markdown rate improved by 140 basis points. When you're not just slashing prices to move inventory, you protect your profit.
That's fascinating because for the person who shops at DSW, that means the days of finding those constant deep clearance sales might be fading.
It's a huge shift. They're telling you, the consumer, we believe in our products at this price, and we're not going to train you to only shop the sales rack. That's a huge risk for a retailer that's historically been pretty discount heavy.
But it paid off.
In Q3, it absolutely did. The second driver was more non-product income in their U.S. retail business. Think sourcing efficiencies and things like that. Little boosts that help buffer the lower sales number.
And that discipline, it really flowed all the way down the income statement, right? We're talking about achieving operating leverage even while sales are shrinking.
Yes, that's what hammers it home. Operating profit jumped about 87% year over year to $42.7 million.
87%.
Which gave them a 5.7% operating margin. Last year, that number was 2.9%. So they nearly doubled their operating margin. To grow profit by almost 90% when your revenue is slightly down,
yeah,
That takes incredible internal control.
Okay, but let's pause on that because this is the big challenge, right? This can't be a totally perfect story.
Right.
Total comparable sales were still down 2.4%. So the question is, can you survive long term just by cutting promotions if your store traffic doesn't eventually turn around?
That is the central tension for the long-term thesis.
Yeah.
And management knows it. They were very quick to point out that the 2.4% comp decline, while negative, was actually a sequential improvement from Q2.
So the bleeding is slowing down.
Exactly. It's getting less bad, which is the first step to getting good.
And where was that sales pressure coming from? It wasn't across the whole business, was it?
No, not at all. The real drag was in Canada retail, which was down 7.5%, and the brand portfolio, that's their wholesale business, down 8.6%.
And the excuse there was weather.
The usual suspects, yeah. Unseasonably warm weather, which hurts boot sales, and some temporary wholesale delivery delays they think will get fixed in Q4.
But the core business, U.S. retail, the DSW stores we all know, that was much more resilient.
Way more resilient. Comps there were only down 1.5%, and total sales were down less than 1%. So where it matters most, in their flagship stores, they're executing really well.
So what's the strategy here? The CEO, Doug Howe, he must have a narrative he's pushing.
He does. He called Q3 another meaningful step forward in our transformation. The whole theme is shifting the product mix toward their own brains.
The owned and licensed brands, right? Vince Camuto, Keds.
Topo Athletic, yeah. Getting away from just being a warehouse for everyone else's shoes and controlling more of their own destiny and margin.
So are we seeing that actually work? Is it showing up at the register?
We are. And this is where it gets really interesting. They said their top 8 strategic brands, they actually posted a positive 4% comp.
Wow. So a positive comp inside a negative comp business.
That's the signal. Those brands are outperforming everything else by a mile, and their penetration is growing. They now make up 42% of total sales.
So they're taking share within their own stores.
That's a perfect way to put it. It's fundamentally changing the DSW model from just a shoe warehouse to a curated brand destination where they control the product and the profit.
Any specific categories that really stood out?
Boots. Despite the warm weather excuse, they said regular price boot sales were up 8%.
At full price.
At full price. Again, it shows when they put the right product out there, people will pay for it. And they saw good momentum in athletic, too. Adult athletic comps were up 1%, and kids was up 8%.
All of this, though, it has to be built on a foundation of really, really tight inventory control.
It's pure inventory genius. They ended the quarter with inventory down almost 3% year over year, and they did it by having 30% fewer choices. Think about that. They're buying 30% fewer styles.
So a much leaner operation. But the risk is the customer feels like the selection is worse.
And that's the clever part. While they cut the number of styles, they simultaneously improve their in-stock levels on key items by 460 basis points.
So they have more of what you actually want to buy.
Precisely. It's the definition of a smarter, leaner inventory. Selling more of fewer, better items. It maximizes cash flow, and it stops you from having to do those margin-killing markdowns.
Okay, let's look at the balance sheet. How is this discipline showing up in their financial health?
It's getting stronger, which is exactly what you want to see in a turnaround. Cash is up to about $51 million, and crucially, they are paying down debt.
How much?
Total debt dropped from over $536 million last year to under $470 million this quarter.
That's a serious reduction.
It is. Cutting debt and shrinking inventory, those are the twin proofs that management is dead serious about fiscal discipline.
And their guidance for the full year, what's the message there?
They're still guiding for sales to be down for the full year in that 3 to 5% range. So they're not promising a miracle on sales growth.
But the profit.
But the profit expectation is the key. They're guiding for adjusted operating income of $50 to $55 million.
So that's the message to the market. We are going to grow our earnings before we grow our revenue. We're getting smaller, but way more profitable.
And that is exactly why the stock did what it did. The market had priced them like a dying retailer that should be losing money. When they proved they could generate $50 million in profit with negative comps, it just annihilated the whole bearish thesis.
We should also quickly note there was a CFO transition.
Right, the call was with an interim CFO. Management stress continuity, but it's something to watch.
Okay, let's get to the fireworks. We can't talk about this quarter without digging into that 50% stock spike. It was a short squeeze.
It was a textbook short squeeze.
Yeah.
And you need the context to really appreciate it.
So what was the positioning going into the earnings print?
It was one of the most crowded short trades in the entire market. Going into that morning, about 8.1 million shares were sold short.
Which is a lot, but the key is the percentage of the float, right?
That's the number that matters. It was a stunning 57% to the float.
57%. So for every 2 shares that were actually available to trade, more than one of them was a bet that the price would go down.
It's the definition of a tinderbox. That much negative conviction is incredibly dangerous. And when the company delivered that massive EPS beat,
It was the spark.
it was the perfect spark. The stock gapped up, and every single one of those short sellers was forced to aggressively buy shares back just to stop the bleeding.
And that forced buying, on top of the actual good news, is what creates that violent 50% repricing in one day. It's a technical event as much as a fundamental one.
And that's the tension here. You have management talking about steady incremental progress, and you have the stock doing a very sharp one-day repricing.
Yeah.
The market is reacting to a positioning unwind.
So now the hard part begins. They have to keep executing flawlessly to justify this new higher price.
Exactly. Interestingly, the stock had already been outperforming the sector even before the squeeze.
Right. It was up like 65% over the 3 months prior.
Yeah, while the main retail ETF, XRT, was only up, low single digits. So the market was already sniffing out that DBI was doing something different, something better than its peers. This print just validated it with an exclamation point.
Which brings us to our high-risk, high-reward segment. And as always, a huge disclaimer. This is not financial advice. We're just exploring an aggressive, maybe even outrageous trade idea based on the data we just went through.
Okay, so let's call this one the profitable deviation pair trade.
I like it. Lay out the thesis for us.
The thesis is simple. The market now knows that DBI has cracked the code on profitability. They can generate significant operating income, that $50 to $55 million, even when their comps are negative. That ability separates them from almost everyone else in the promotional retail space.
So we believe their unique success will continue, while the rest of the sector just kind of muddles through. How do we build a trade around that?
It's a paired trade. So there are 2 parts. Action 1. You take a high conviction, long position in DBI.
You buy the stock.
You buy the stock. You're betting on their sustained margin execution. And crucially, you're betting that the short interest, which is still very high even after the squeeze, will act as rocket fuel on any future good news.
Okay, that's one side. What's the other half of the pair? The deviation part.
Action 2. You simultaneously short the retail ETF, XRT. You're betting that the broader apparel and footwear sector stays choppy and promotional.
So you're long the one company that's figured it out, and you're short the rest of the pack that hasn't.
Exactly. The trade is designed to capture that relative outperformance we've already seen. You're betting specifically on DBI's unique ability to grow earnings before they grow revenue.
A really aggressive bet on idiosyncratic success in a tough sector. Isolating the alpha, as they say.
That's the idea. High risk, but based on a confirmed trend.
Okay, let's wrap this up. To recap this deep dive, Designer Brands, Inc. delivered a phenomenal profit beat. It was driven by an absolute masterclass in margin discipline and inventory control, all despite a small revenue miss.
And that fundamental strength was the fuel for a spectacular short squeeze rally that sent the stock flying, all because of an incredibly crowded negative bet against them.
So here is a final provocative thought for you to chew on. Now that the crowded short position has been blown up, can DBI's management maintain this incredible level of discipline and turn a one-day technical spike into a sustainable, multi-quarter fundamental growth story?
We appreciate your time today. And remember, the content you heard is for informational purposes only. It is based on publicly available data and is absolutely not financial advice. Always consult with a certified financial advisor before making any investment decisions.